Okay, any questions on that? Any questions on that? Nosi? Brandon?
No, so far so good on my side.
Yeah, most of good.
Okay. So, within the context of ultimate lenders and ultimate borrowers, what does it include? It includes households, which could be individuals, which could be families, which could be charities, religious groups, even non-profit making organizations, unicorporate businesses, which could be farmers and retailers. These are all included as being households, okay? So these households can either be lenders, they can also be borrowers, okay? We also have firms. These firms can be lenders. These firms can also be borrowers. They include the corporate sector. They include business enterprises. We also have the government. The government can also be a lender. The government can also be a borrower. It can do so through its treasury. We also have the foreign sector, which is the fourth economic agent, which comprises of all other organizations, persons or assets residing outside South Africa. So within the foreign sector, it could be households residing outside South Africa. They could be firms residing outside South Africa, or it could be the government of another country, okay? So we have what is known as direct financing. Direct financing, we also have indirect financing. Direct financing is whereby the lender and the borrower, they meet up without any intermediary in between, okay? Direct financing is whereby a corporate can simply issue out corporate bonds. You purchase that corporate bond without any intermediary in between, without any financial system acting on behalf of each other. And that is known as direct financing. So direct financing is whereby, let's say, Eskom can issue out bonds, can issue out shares on Johannesburg Stock Exchange. You as an investor, you simply purchase that share. So there is no any banking sector, there is no any financial intermediary which is acting on behalf of each party. So indirect financing now, indirect financing is whereby the lender or the investor may simply serve within the banking sector. When this investor serves within the banking sector, invests within the banking sector, those who are willing to borrow will now approach the banking sector, will not approach individually the investor, and that is known as indirect financing. So basically, indirect financing is whereby there is now an intermediary that matches the borrower and the lender, satisfy both parties, okay? So within indirect financing, the lender approaches, maybe it could be the banking sector. Those who are willing to borrow approaches the banking sector. The lender and the borrower do not meet, okay? And it is the opposite of what? Of direct financing, okay? We have direct securities. We have secondary securities. Direct securities are financial instruments sold for the first time. They have never been sold before, okay? They have never been sold before. They are now sold for the first time, and they are called direct securities. Secondary securities Previously, they were direct securities, but now they are being resold and they become known as secondary securities. So these are financial instruments that have been sold at least once and are now resold. So a direct security can become a secondary security if it is then resold. Okay. Primary securities represent a financial transaction or an obligation between an intermediary and a borrower. Indirect securities represent a financial transaction or an obligation between a lender and an intermediary. Okay. This is between a lender and an intermediary, but primary security is between the intermediary and a borrower. So we are saying that in between, we have an intermediary. A lender and an intermediary, these are indirect securities. A borrower and an intermediary, these are now primary securities. Okay, is it making sense?
Yes.
Yes.
Okay. So direct financing, we have discussed about direct financing. We have discussed about indirect financing. Okay, so let's take a look on non-reversible instruments and reversible instruments. Non-reversible instruments must be held until their expiry date. If they expire in 2030, they must be held until 2030. They cannot be traded before that. Okay. So these are known as non-reversible instruments, which are held until its maturity date and may not be resold. For example, insurance policies or mortgage bonds. Reversible or negotiable instruments may be sold as required. These do not need to be sold on the maturity date. They can be sold at any period of time. They can be sold on or before its maturity date, and they are known as reversible or negotiable instruments. Okay. A TB, a treasury bill. So a treasury bill is issued by the treasury. It is issued by the government. This is a government which is trying to raise some funds. So the government can raise some funds through the issuance of treasury bills. Okay, and this is done through the government treasury. So a treasury bill is a short-term paper with a term of 3 months. It is short-term, meaning that the government is wanting to raise some short-term funds. Okay, so how do they do? This is also known as debt financing. The government can finance its debt through the issuance of a treasury bill, which is issued through the treasury. So the treasury or the government may use this instrument to raise short-term money to relieve cash flow shortfalls caused by the fact that its expenses are monthly. Maybe this could be through the payment of salaries, those bureaucrats. The government will need to pay these salaries at the end of the month, but its revenue would be not coming after each month. It could be coming semi-annually, or it could be coming annually. The government could be receiving its tax revenue semi-annually or annually, but it needs to pay salaries each and every month to workers that work within the government, okay, which are known as bureaucrats, okay?
Yeah.
Okay, is it making sense, Brandon?
Yes, it is.
Okay, Nosi?
Yes, so far so good.
So far so good, okay. Okay. So we have what is known as a spot transaction. We have what is known as a spot transaction. We also have what is known as a forward transaction. A spot transaction is one which is fully executed within 4 working days. It will be known as a spot transaction. A forward transaction is the opposite of a spot transaction. A forward transaction is whereby we simply enter into a contract today. Let's say with a bank, you simply enter a contract with the bank today. This contract could be for the fact that maybe at some point in time, you want to purchase, maybe you want to purchase foreign currency, but you want to purchase foreign currency in 2022. You agree today on the price that you will going to use. You also agree on the quantity. You also agree on the date, but that will be known as a forward contract or a forward transaction. No transaction takes place today. Today, you simply enter into a contract. But when we are making reference to a spot transaction, is whereby the contract is executed within 4 working days, okay? And that will be known as a spot transaction. We also have over-the-counter transactions, which are transactions that are informal. Over-the-counter transactions, these are transactions that are informal. The Johannesburg Stock Exchange is primarily a secondary market, since most shares traded have been traded before. So over-the-counter transactions, they are informal. This does not need to take place on a single geographical place. They are known as over-the-counter transaction. You can enter into a transaction with someone in Sweden. You can enter a transaction with someone in China. And these transactions, they are done through what is known as over-the-counter transactions, okay? The South African Reserve Bank debentures are money market instruments. They are money market instruments in that they enable the control of money supply. So we have money market instruments. We also have the capital market instruments. The money market instruments, basically, they mature within a short-term period of time compared to the capital market instruments. So the sub-debentures are money market instruments in that they enable the control of money supply. The South African Reserve Bank also have the mandate to control the level of money supply. They know that if they control the level of money supply, indirectly, they are controlling the rate of inflation. However, the way the money supply is controlled nowadays is through interest rates, basically through what is known as the repo rate, okay, or the repurchase rate, which is used when there is too much liquidity to curb credit and spending, and drop when spending is encouraged. It is dropped when spending is encouraged by making it cheaper to borrow. So basically, the South African Reserve Bank can use interest rates so as to manage money supply. How do they do so? They raise interest rate when there is too much liquidity, when there is too much money supply, when too much money is circulating within the South African economy, they raise interest rates. If they raise interest rate, we have said before that interest rate is the price of money. If they raise interest rate, what would happen? Let's say, Brandon, you want to borrow, you are a borrower. Within that perspective, you have heard that interest rates have been increased from 6% maybe to 11 percentage points, what would you do as a borrower? Would you borrow more or you would borrow less?
I would borrow less.
You would borrow less because at the end of the day, you know that when I now need to settle this debt, I will have to settle it by the interest that have been raised. Ne? So basically, interest, like what we have said before, that interest basically is the cost of money. So if we raise interest rate, we have simply raised the cost of money. It is now more expensive to borrow, okay? And then at the same time, no, see, as an investor, what would you do? No, see, you are now an investor.
Yes.
You are not the borrower. The interest rate has been increased. Would you invest less or you would invest more? What would you do? You are a rational investor.
I would invest more because the interest will be higher. My returns.
Exactly. So your returns will also be
more.
Will be more. So this is how the South African Reserve Bank tries as much as possible to control money supply. Okay. They know that if they raise interest rate, you will borrow less, more money will be kept within the banking sector because less loans are now being made. Okay. Remember, money supply is credit that is outside the banking sector. Okay. That is what is referred to as money supply. Okay. So if interest rates are raised, you will borrow less, meaning less money balances will leave the banking sector. At the same time, as rational investors, you will take more of your money balances to the bank so as to earn interest. So at the end of the day, there is now a reduction in the level of money supply, okay? If there is a reduction in the level of money supply, what will happen to inflation? Brandon?
I think it will drop.
The rate of inflation is likely to drop, okay? And the other way around, the opposite is true if we decrease the rate of interest, okay? Okay, let's take a look on, so we have different kinds of investments. We have different kinds of investments. We have what is known as financial investment or portfolio investment. It is also known as portfolio investment. We also have what is known as real investments. Okay. Financial investments is simply the purchase or sale of financial instruments. Okay. And that is known as portfolio or financial investment. Real investment is now investment in capital goods, investment in machinery, investment in plant and equipment, investment in inventory, and that will be known as real investment. So the financial or real investment could be domestic investment. It could be foreign investment. Foreign investment could be in the form of foreign portfolio investment, could be in the form of foreign direct investment, which is also known as real investment. Okay. So Between financial investment and real investment, let's assume Nosi, you are a policymaker. You are a policymaker. Between the two, between financial investment, which is simply the purchase or sale of financial instruments, which is simply the purchase or sale of stocks of equities, and real investment, which is investments in capital goods, investment in machinery, investment in plant. So if you are a policymaker, between these two, which policies would you put in place, or literally, which type of investment would you favor the most between financial investment and real investment for the interest of the economy as a whole, for the interest for the development of the economy, for the interest within the growth of the economy? Would you put much energy?
I think.
Yes.
I think I would go for the real investment in investing in building a company, creating employment, and having production, which will create the economy and have more work. So I think I'll go for the real investment.
Okay. Great. That's wonderful. Brandon, would you support or you would argue?
Yeah, I'll also say real investment, majority of it, but I think a bit of both.
Yes.
Can I add on with the real investment? You'll also be creating employment as well.
Exactly.
So there's also people that are involved who will also contribute to the economy, you know, and they get the taxes getting deducted and all of that stuff, so the economy will flow.
Okay. Yeah, that's wonderful, Nosi. Okay, so with regard to real investment, with regard to direct investment, we are saying we have entrepreneurs, we have foreign investors that are coming into South Africa. They are building up factories, they are starting up businesses, they are investing in capital goods, they are investing in machinery. At the end of the day, they will employ South Africans. What will happen to the unemployment rate? The unemployment rate is likely to drop. At the end of the day, those who are employed, they are now able to finance or purchase basic goods. So there is also a development. And within that context as well, Nosi have brought also an interesting point to say they can be taxed. They also contribute to the government revenue, okay? They also contribute to the government revenue. They also contribute to national output at the end of the day. If they contribute to national output, if the gross output within South Africa, if the GDP increases within South Africa, there is also a likelihood that inflation will drop, okay? Why? Because there are now more output, there is now more goods that are being available. And within that same token, there is now variety within the market itself. So real investment is much more preferable compared to financial investment. Financial investment is simply an investor who may have approached Johannesburg Stock Exchange, purchase his or her share, and at the end of the day, it's he's the one whom attains the benefit. It does contribute to the economy, but you can see that at the end of the day, real investment has more outweighing benefits compared to financial investment. Okay. Okay, so thank you for that. Okay, so the return is the earnings of a financial investment. So out of a financial investment, you get a return, which are the ones which we are referring to as earnings. This could be in form of income yield. This could be in the form of capital gains. So income yield is the income component of the return itself. Normally payment of cash, okay, is the income component of the return itself. You have invested in the financial system, you have invested in the financial market, you earn an income out of it, which could be in the form of cash, which is the one we are referring to as income yield. This cash is either an interest payment or a dividend payment. It could be an interest payment or a dividend payment. Okay, so interest payment would be in line to the fact that you have purchased an equity, you have purchased a bond, and then you earn interest, or you have simply invested, you have saved your money balances, you earn an interest out of it. Dividends would be now in the form of a payment of being a shareholder. Okay, so these comprise what is known as income yield. We also have capital gains, which is simply the difference between the price when an equity or a bond have been sold and the price realized afterwards. Okay, the price before and the price which has been realized when sold. So you purchase an equity, you purchase a bond today, you then resell it at some point in time. If you sell it at a higher price than today, that would be known as a capital gain. If you sell it at a lower price,